Real estate investors are always interested in whole life insurance after they learn about the cash value and how it works. However, one thing I've seen happen to so many investors is they get a whole life insurance policy, they plan to use it for their real estate business, but after they put money into the policy, they find out that they got a bad deal. Usually, they find out that the cash value was not maximized and they're paying a lot of fees and commissions with the life insurance product. This is usually what happens. So what we'll cover is our 3-step guide to getting a whole life insurance policy and then using it to buy real estate. Let's get on into it. So, step number 1, we want to get the most cash value we possibly can on day 1. Here's what to do. We'll look at one insurance company and one insurance product, and we'll look at 3 different ways we can set the policy up. So we've got a simple example of $10,000 per year going in for 10 years. That's a total of $100,000. And here's a side-by-side comparison. You've got options A, B, and C. Which option gives you the most money in the first year? Option C, a lot more. You've got $8,700 and change. How about the 10th year? Well, it's also option C. Year 20? Also option C, significantly more than the other 2. What about year 30? You can see the trend here. Option C is the only product that has cracked $300,000. So option C has the most money. Why? Here's the technical reason. Of that $10,000 going into the policy, you, the policyholder, along with the agent, can decide where your money goes. It can go toward the base premium or toward the PUA rider. PUA stands for paid up additions. I like to call it a cash dumping. What we want to do, if cash value is what we're interested in, is minimize the premium as much as the insurance company will allow and as much as the IRS will allow, and maximize that PUA rider. Option C has a base premium of 10%. So when we look at a detailed breakdown of option C, you'll see of the $10,000, that column in red, $1,000 going toward the premium, $9,000 going toward PUAs. That's what gives him the most cash value from start to finish. Another huge advantage to so many real estate investors with this is flexibility. So pretend that you're paying $100,000 per year. Would you be committed to that? Your commitment is the base premium. You can add money to PUAs at your leisure. So this way you can use a policy as a flexible savings asset instead of just a boring insurance bill. That's step 1. Step 2, policy loans. What you need to know. To demonstrate this, we'll look at a case study. We're going to look at a real estate investor who plans to fund a policy for 5 years. He wants to buy a property for $300,000, and what we'll review is the cash value. So, first step we'll take is looking at a policy where we pay money in and just let it sit and grow. So he pays $100,000 per year for 5 years. After that, he pays zero, no premium, nothing at all. He just lets it grow. By year 6, which is age 50, he's got more than $530,000 in cash value, and his death benefit is $1.8 million. By age 58, the cash value has grown to about $755,000, and the death benefit's still $1.8 million. Okay. So we've got the example where we just let it sit and grow. Now we're going to look at loans. So we're going to take that $300,000 loan to purchase a property. The impact on the cash value is what? At age 50, his cash value is now $218,000 and change. His death benefit is now $1.5 million. Both the cash value and death benefit reduced. The death benefit reduced by exactly the amount that we pulled, $300,000. You'll always see that happen. Now, he begins to repay the loan at $50,000 per year. You can pay loans back however you want. Of that $50,000, in purple, we see how much is applied to the principal, and in red, we see how much is applied to the interest. And then the loan balance is shrinking over time. If this is me, I would want to know how that $300,000 loan impacted my policy. Here's the question. What does your policy look like after the loan is repaid? Well, here's the chart with a million columns. Let's just look at age 58. Your cash value is about $755, and your death benefit is $1.8 million. What does that look like compared to the example where we just let the money sit and grow? It's exactly the same. Your cash value kept on compounding by 4 to 5%, even though you took that money out and went out and purchased a property. And you earned a return on your property, by the way. This is how people use whole life insurance to buy real estate. Step 3, know your numbers. What is the actual cost to borrow? We can look at the interest rate, but we do need to recall here that we're also earning interest on the money that we're paying interest on, so it can be a little bit complicated. So here's an easier way to look at it that I like a lot. I like to look at it in dollars, and I'll take the cash value growth minus the loan interest. And what this shows me is how much the insurance company is paying me in total dividends and interest, and then how much I'm paying them in loan interest. So first, let's go through the cash value growth. We'll look at the yearly growth and the total gain. So with the yearly growth, what this means is how much money you received from the insurance company in 1 year. So if we look at year 1, you pay $100,000, your cash value is $92,000 and change with this product. That's a negative $7,700. It's a loss. This is the drawback of whole life insurance, by the way. This is what everyone tries to hide, but it's very important to be aware of. Now, as time passes, it gets better and better. So the 10th year, you have $636,000 in cash value. Year 11, you pay $0. Your cash value is now $663, which means it grew by $27,000. That's the yearly growth. How much money you received from the insurance company in that particular year. Next, the total gain. This one's a bit easier. We paid a total of $500,000 into the policy. So if we look at year 10 again, I've got $500 that I paid. My cash value is $636, which means $136, everything above the $500,000, that's my gain. Simply put, the total gain is how much more I have in cash value than what I paid into the policy. So that's what I'm getting from the insurance company. Now let's look at the loan interest, and then we'll compare the two side by side. So, loan interest, yearly interest, and then total interest. Yearly interest, I'm looking at what I'm paying every year. So with a $300,000 loan, I've got $16,680 in loan interest I paid to the insurance company in the first year. The yearly interest represents how much I'm paying to them every single year, but I'm isolating each year. The total interest just tallies up all of the interest payments I've made and gives me a grand total. A lot like looking at a mortgage, if you said, what's the total interest I'm paying the bank over the 30-year term? And you can see the total number at the bottom. So to get the net cost to borrow, or the net earnings rate, I want to take the cash value and subtract it from the loan interest. Yearly cash value growth and yearly interest paid. Let's look at year 7. The growth, $23,000 and change. What I paid, $16,000 and change, which means I have a net gain that year of $7,200. And if I used this for real estate and earned a return on my real estate, well, that return on real estate would be added to the $7,200 because I'm still earning interest on everything. Let's look at the total gains. By the 15th year, my gain is $288,000. The interest I've paid is $75,000 and change, which means my net earnings are $212,000 and change just within the policy. So these earnings are what you earned within the policy. I would then add my returns from real estate to these numbers. This is how real estate investors use whole life insurance. The lesson: always look at the numbers or have someone show them to you. That's something we really try to focus on with everyone we work with. This way they don't have to number crunch, we'll do it for them. The numbers are going to tell you if this is a good strategy or not. So I hope you enjoyed the 3-step guide of using a whole life insurance policy to buy real estate. If you'd like to see how this can work for you, please complete the form below or reach out to us. Personally, I would love to connect with you. And that's all we have. Bye for now. Thanks so much for watching.